China has slashed its holdings of U.S. Treasuries to a 17-year low, accumulating gold for 14 consecutive months, while America's debt hits record highs. This isn't just portfolio rebalancing. It's the calculated dismantling of financial dependence that could reshape global power forever. In November 2025, China's Treasury holdings dropped to $682.6 billion, marking the lowest level since September 2008, during the height of the financial crisis. But here's what makes this moment different. While China pulls back, total foreign ownership of U.S. debt is actually hitting record highs. Japan increased its holdings by $2.6 billion to $1.2 trillion. The UK boosted exposure by $10.6 billion to $888.5 billion. China alone is moving against the tide, and they're doing so with surgical precision. This represents a nearly 10% decline in Chinese Treasury holdings since January 2025. To put that in perspective, China has reduced its exposure by roughly $75 billion in a single year, while maintaining the world's largest foreign exchange reserves at $335.79 trillion. They're not selling because they have to. They're selling because they want to. The numbers tell a story of strategic repositioning. While China dumps American debt, the People's Bank of China has embarked on a gold-buying spree unlike anything we've seen in modern history. In December 2025 alone, China added 30,000 troy ounces of gold to its reserves, bringing the total to 74.15 million ounces. This marks the 14th consecutive month of gold accumulation, a pattern that transcends normal central bank portfolio adjustments. Xiao Yu, chief economist at Fudan University's Sci-Tech Innovation Management Research Center, put it bluntly. The massive accumulation of debt resembles a Ponzi scheme, where larger volumes of new debt are used to replace the old. China doesn't want to play this game anymore. That's not diplomatic language. That's a direct challenge to the foundation of American financial dominance. China isn't alone in this pivot. India has quietly followed a similar playbook, steadily reducing U.S. Treasury holdings while simultaneously increasing gold reserves. Gaura Sengupta, chief economist at IDFC First Bank, explains India's strategy. India's lower holdings of U.S. Treasury bills reflect the RBI's push to diversify its foreign exchange reserves by buying more gold. Rising fiscal pressures in advanced economies have pushed up global bond yields, increasing the risk of valuation losses on reserves held in treasuries. Notice the pattern emerging here. Two of the world's most populous nations, representing over 35% of global population and increasingly significant economic weight, are systematically reducing their exposure to American debt while building alternative stores of value. This isn't coincidence, it's coordination. The timing of China's accelerated pullback is particularly telling. The reduction intensified precisely as geopolitical tensions between Washington and Beijing reached new heights. While Chinese officials frame this as technical portfolio optimization, the messaging is unmistakable. Shi Junyang, professor at Shanghai University of Finance and Economics, offers the official line. The decrease in China's holdings of the U.S. Treasuries is a result of increased optimization and diversification of holdings of foreign assets seen in recent years, which helps strengthen the overall safety and stability of the portfolio. But scratch beneath the diplomatic veneer, and you'll find a more complex reality. China is building financial infrastructure for a world where American dominance isn't guaranteed. Gold accumulation serves multiple strategic functions beyond traditional hedging. It provides protection against financial instability, sanctions risk, and currency weaponization, all increasingly relevant concerns as U.S.-China tensions escalate. The January 2026 Treasury market shock exposed just how vulnerable this system has become. Market analysts identified what they called a three-headed monster driving the turmoil. First, the Japan bond rout created yield pressure that reduced global demand for treasuries. Second, the emergence of what traders dubbed the Sell America trade, not coordinated dumping, but a systematic reassessment of U.S. policy risk. Third, underlying doubts about long-term American fiscal sustainability provided fertile ground for the other factors to take hold. What made this shock particularly concerning was its coincidence with elevated geopolitical tensions, including what sources reference as a Greenland dispute. The market stress reflected not merely economic mechanics, but eroding confidence in U.S. policy reliability and stability. The concentration risk paradox adds another layer of vulnerability. While foreign ownership of U.S. Treasuries has reached record highs, the holder base has actually narrowed and concentrated among fewer, larger participants. This creates structural weakness. When marginal holders like China exit systematically, the market has fewer alternative buyers to absorb the supply. European pension funds began explicitly citing U.S. fiscal health concerns in their own divestment decisions. The dollar weakened. Precious metals surged. What started as Chinese policy had evolved into a market-wide phenomenon, questioning America's financial foundations. Here's what's particularly striking about China's gold strategy. Chinese economists specifically noted that gold still constitutes a relatively smaller share of total Chinese reserves compared to other major economies. This suggests significant runway for continued accumulation. They're not approaching any natural ceiling. They're just getting started. The implications extend far beyond portfolio management. Reserve currencies don't disappear overnight, but they erode gradually as marginal decisions shift away from traditional, safe havens. China's decade-long Treasury reduction exemplifies this process. Each month of continued selling and gold buying represents another small step away from dollar dependence. Consider the broader context. China maintains 3,379 trillion in foreign exchange reserves, the world's largest stockpile. This provides enormous flexibility to continue restructuring reserve composition away from U.S. assets toward gold and other diversifying holdings. They have the resources to sustain this strategy for years without compromising financial stability. The geopolitical dimension can't be ignored. China's pullback accelerated amid concerns over Federal Reserve independence under the Trump administration. Rising fiscal deficits, political pressure on monetary policy, and growing polarization around economic governance all factor into Chinese risk calculations. They're preparing for a world where American institutional reliability can no longer be assumed. But this strategy carries risks. Gold provides store of value but limited yield. Reducing Treasury holdings means forgoing the liquidity and income of the world's deepest debt market. China is essentially paying an opportunity cost to build strategic independence, a calculation that reveals how seriously they view the long-term risks of continued dollar dependence. The parallels to historical precedents are unsettling. Previous reserve currency transitions occurred gradually, then suddenly, as confidence eroded and alternatives gained credibility. The British pound's displacement took decades of incremental shifts before accelerating rapidly after World War II. China's methodical approach suggests awareness of these historical patterns. What makes this moment unique is the absence of a clear alternative reserve currency. The euro lacks political unity. The yen represents a shrinking economy. The renminbi remains constrained by capital controls. Instead of currency substitution, we're seeing diversification into real assets like gold, a return to more fundamental stores of value. The January 2026 market events provided a preview of potential future dynamics. When confidence in U.S. fiscal sustainability wavered, investors demanded additional compensation for policy risk. The dollar declined. Alternative assets surged. European institutions began explicit divestment. These patterns suggest how broader loss of confidence might unfold. For China, this represents the economic dimension of strategic competition. Building financial independence reduces American leverage while creating optionality for future policy choices. Every $1 billion moved from treasuries to gold represents decreased vulnerability to financial sanctions, currency manipulation, or asset freezes. The Indian parallel suggests this isn't uniquely Chinese strategy, but emerging multipolar consensus. Rising powers are quietly building alternatives to dollar-centric financial architecture, not through dramatic confrontation, but through patient systematic repositioning that accumulates over time. China's gold accumulation, despite historically elevated prices, reveals the strategic nature of these moves. This isn't opportunistic buying during market dips. It's structural repositioning, regardless of short-term price considerations. They're building long-term strategic assets, not optimizing quarterly returns. The 14-month gold buying streak represents institutional commitment, extending beyond typical central bank operations. This suggests high-level strategic guidance, driving systematic implementation of reduced dollar dependence. It's coordinated policy, not ad hoc portfolio adjustments. As we look ahead, several questions emerge. Can the Treasury market maintain stability as major holders reduce exposure? Will other emerging economies follow the China-India playbook? How will American policymakers respond to eroding financial dominance? What's clear is that China's Treasury pullback represents more than portfolio optimization. It's the quiet construction of financial independence from American monetary hegemony. Through patient gold accumulation and systematic debt reduction, China is building the economic infrastructure for a multipolar world. The numbers don't lie. 14 consecutive months of gold buying, a 10% annual reduction in Treasury holdings, the lowest exposure since the 2008 financial crisis. These aren't random market movements. They're the calculated steps of a rising power preparing for a future where American dominance isn't guaranteed. History suggests that financial power follows economic weight with a lag. China's economy continues growing while America grapples with unsustainable deficits. The Treasury pullback may mark the beginning of a broader realignment, reflecting these underlying shifts in global economic gravity. The transformation won't happen overnight, but it's happening. Every month of continued Chinese selling and gold buying chips away at the foundations of dollar dominance. What we're witnessing isn't the end of American financial power, but the beginning of its gradual erosion. One Treasury sale and one gold purchase at a time.